Good day and welcome to the KP Kona Perspective Asset Market Report for the year ending December 2023. This is the second in our five-part series that follows on the big picture. From here, we'll be going into the portfolio components, both local, international, as well as how the Kona Perspective Flexible Fund is positioned and performing. All right, so starting with some of the bigger picture stuff, commodity prices, and all we're illustrating here is the price changes, for example, over 3 month, 6 month, 1 year, 3 year, and 5 year view. As you can see, over the last 3 months and 6 months, commodity prices generally quite a bit weaker, although was somewhat of a mixed bag. If you look over a 1 year view, which is probably quite useful for us, seeing as a lot of this is focused on the 1 year, you'll see certain commodities like palladium and oil down around 30-35%, and even iron ore a little bit weaker. And of course, that's really in large part, we believe, attributable to the supply shortages and the concerns that were brought on by the Russian invasion of the Ukraine. Generally, commodity prices, if you look over, say, 3 years, better, but not spectacularly so. And we also need to, of course, keep in the back of our mind that miners have experienced quite a lot of input pressure, not only in the form of energy, but generally quite a lot of inflation pressure. So that doesn't augur well, obviously, for corporate profitability in the commodity sector. Looking at currencies, the first 4 columns there being the rand. Once again, that's the percentage change. Rand, pretty much as everybody knows, weaker across the board. This is obviously to the end of December. Over a 1 year, for example, down anything from 16% to the US dollar to around 23% against the Swiss franc. Yeah, and as you can see there, slightly weaker relative to the pound and the euro, and less so against the dollar. And as you can see on the 2 right columns there, the dollar itself a little bit weaker over the last 3 months, 6 months, and 1 year, and even against some of the other crosses over slightly longer periods. So rand generally weak across the board, but also you can see that the US dollar is starting to show some vulnerability, and that's probably logically as a result of interest rates around the world starting to normalize a little bit, and also the flight to safety maybe starting to evaporate. Probably on growing concerns around US debt. All right, so the question, I think, for a lot of South Africans, and it's probably a question we ask ourselves quite often, is it over for the rand? We've got the tombstone for the rand saying that here it lies, 1961 to 2023, and we don't think so. Context and history is important. This is just the 10-year chart, and if you look over a 20 or 30 year, it becomes even more telling. And really what we're trying to illustrate with this chart is that the rand tends to do this every so often. You can see in 2016, rapid weakness, obviously driven by politics and Nenegate. And equally in 2020 with COVID, rand got sold off quite aggressively and how it fought its way back. And all we're trying to illustrate here is that orange line is the 200 moving day average. And we're not for a second, espousing technical analysis as the holy grail, but it is actually quite a useful indicator in telling you when the direction is changed, when the trend has changed. You can see sort of from 2020 and in later in 2016, once it breached that on the way down, which is obviously the strengthening on this chart, you could see significant strength over a period of time. So if you go, for example, 2020. We were up at 19 and we recovered all the way down to sub 13. It's difficult to call, but of course we must always remember that currencies are a two-way bet. It's basically betting again one currency against the other, and we're starting to sense that maybe some of the other developed market economy currencies, dollar, euro, pound, have their own challenges. So all we're saying is we don't think we should bury the rand just yet. Like the South African economy, it could actually surprise us on the upside. All right, then having a quick look at bonds. Firstly, US 10-year, and yeah, I mean the 10-year is not a great proxy for the yield curve, but it's a good ballpark. As you can see, US Treasuries ratchet up from early 2020 well under 1% all the way up to 5%. They've now settled back in the early fours, around 4.30. Interestingly, if you look at the next chart, which plots it over inflation, you'll see that you're actually getting a positive yield, as we discussed in the big picture, for the first time in quite a long time in US 10 years. Then looking at US bond prices, interestingly, prices obviously moving inversely to yields. We see an opportunity for, let's call it a tactical return. As you can see, bond prices well down from where they were in 2020, which is obviously somewhat of an anomaly. But even if you took an average, from that 2014 through to 2020 period, obviously current prices offer, we believe, a unique opportunity from a tactical point of view, and of course one is being compensated with attractive yield. Then moving on to UK bonds, similar sort of picture. Yields haven't maybe come off quite as much, obviously as inflation there a little higher, as we can see on the next chart. And as we were just saying, if you look at yields, still negative, the blue line being the UK 10-year yield, and the orange line, the inflation rate. So yields still quite negative there, and that partly explains the fact that those yields haven't come off quite as much as in the US. Then looking at UK bond prices, very similar sort of picture to what we're seeing in the US, maybe even a little more so. Prices very, very suppressed relative to what we were seeing over the last decade. But of course, one must temper this with some caution, because governments around the world are running quite big deficits on balance of arguments, and lots more paper hitting the market. All right, then looking at Europe, you've seen those yields come off quite sharply. Obviously, never went quite as high as in the US or in the UK. And there you can see it in bond prices, also probably offering somewhat of an opportunity, but considerably less so than in the US and the UK. In fact, if you look back to 2015, 2016, in fact, bond prices were quite similar. It's obviously a government bond fund as a proxy. Okay, so our summary on global bonds, we feel that there's a short-term return opportunity in both yield and growth potential. As you're probably aware, we've chosen for much of the last while to park rather in very, very short duration corporate bonds. We feel that tactical shift towards government bonds, but without going ridiculously long on duration, is a good opportunity. And the reasons for that is we believe that inflation will continue to moderate towards its target. The central banks will also probably want to pull rates lower and the yield curve lower, particularly if growth disappoints. And as we saw in the big picture, certain parts of the world, the growth forecasts are not looking great. And there is obviously always those sort of black swan risks to global growth. So we just keep that in the back of our minds. So the chances of yields blowing out are very, very limited relative to them coming off. And then finally, somewhat of a political debate, and I'm sure a lot of people would argue this, but we believe that governments, particularly the US, need to see the yield curve lower, because interest payments are starting to become quite a significant part of the national budget. And then, of course, the key question is where yields are going to settle in a 2% inflation world. And it's actually quite hard to say, but we do believe that they will settle a little lower, at least tactically. So there is, as we say, an opportunity there. Looking at local bonds, the 10-year doesn't really tell the full story. As you can see, the 10-year here under 10% at year end. Move a little further out in the yield curve, sort of 14, 15, 17 years, and you see those yields spike up quite significantly to 12% plus. So the yield curve definitely offering more of an opportunity than say SA 10 years. This is evidenced in the Govie index, which, as you can see, is considerably down from where it was. So we feel if you look at yields on reasonable duration of 10% and above, there's not only an opportunity to lock in return, particularly sort of for retirement-oriented investors, but also we think there might be an opportunity, just like in global bonds, for a little bit of a tactical allocation from a capital growth point of view. All right, then equities. Obviously, a lot happening in equities, starting with global equities. The more recent performance here, you see the 3 month, 6 month, and 1 year performance on a couple of the major indices. You can see the Nasdaq really shooting the lights out, 54% up on a 1 year view. That's pulled the S&P 500 up, whereas the Russell 2000, for example, is only up 15%, and the Dow similarly 14%. These are obviously the performance figures up to the end of December. January was a bit of a shocker, so that you've seen the likes of the Russell give back a fair amount. Interestingly, the FTSE, as usual, disappointing, just up a couple of percent on a 3 month, 6 month, and 1 year view. And then the Stocks 50, bearing in mind we had the fairly low base effect courtesy of the Ukrainian war. That's recovered quite nicely over 1 year, but less convincing over a 6 month. And then China and Hong Kong, I think Hong Kong really just following China, but also having its own issues. The real underperformer, relatively speaking. So quite scary if you look at the divergence in performance between, say, the Nasdaq and the Hang Seng. Looking at slightly longer term performance internationally, once again, the story remains the same. Hang Seng down over 5 years, an incredible 34%, way underperforming the CSI 300, the Chinese index. There you can see, the Russell doing less than a third of the performance of the Nasdaq over 5 years. Nasdaq doing 166%. Obviously, in the latter part of last year, once again to the end of December, the excitement around AI and the Magnificent Seven really buoying that. But as you can see there, the FTSE over a 5 year up 15%. It obviously has been weaker in the new year. And then the stocks, a relative outperformer, performing more in line with what the Dow and the Russell has done. All right. If one looks at the S&P 500, 15.8% in the last 2 months. And you're going to see where that performance actually came from, and really that excitement driven in large part by what we call the Magnificent Seven, which is NVIDIA, which is very much seen as a beneficiary of the AI story, but also Meta, which is Facebook, Tesla, Amazon, Google, Apple, and Microsoft. Interestingly, Microsoft, the relative underperformer in that cohort with a 31% performance. We'll talk in more detail about that stock in our offshore portfolio commentary. Obviously, more recently in the last week or 3, we've seen the likes of Tesla give back quite a bit. But the bottom line is that you can see the performance of the Magnificent Seven over a year view, 71%, whereas the rest of the S&P 500, effectively the other 493 shares, only doing 6%, and that's how we got to that average S&P performance. So, yeah, really a handful of counters driving the performance there, and we'll talk more about the valuations in this video, and more importantly in subsequent on offshore portfolios. Okay, that's the Nasdaq, as we can see, as at year end, knocking on the door of a record. It did go through that, but as I say, in the last couple of weeks, maybe giving back ever so slightly. The FTSE 100 really going nowhere in a hurry. You can see lots of sort of knocking on record territory and just unable to breach, probably in large part because of the makeup of that index with a strong financial and mining base. Stock 600 has recovered nicely, as we say, courtesy of the lows sort of just after the Ukrainian invasion. Yeah, but even if you look, over a 5 year view, not really spectacular. And again, 1 or 2 counters really helping to propel that index forward. CSI 300, which is China, obviously weighed on by some of the political issues and the economic issues. We spoke a lot about that in the big picture. If China were able to do a 5% and avoid sort of some structural problems in terms of their economy, I think it could surprise the markets on the upside. We're seeing an opportunity in China and less so in Hong Kong, although one must be fairly vigilant to the index you choose, because you don't want to have too much banking exposure, and also although tech offers an interesting opportunity, so we just think slightly more diversified and balanced exposure is probably sensible. All right, then moving on to South African equities, local equities. We've got the 1 month performance here simply because it was just such a volatile period. You can see tech in the month of December down 10%, driven mainly by Naspers and Prosus, but the broader market actually looking a little bit better. Again, we must remember that Naspers and Prosus are once again actually quite significant components of that index, so that makes the rest of the performance so much better. As you can see, small caps, mid caps actually doing quite nicely in the month to this end of December. On a 1 year view, banks and local industrials, so effectively the SA stocks, really helping a lot, and on a 1 year view, tech still doing reasonably well. As you can see, the underperformance there once again from basic materials and telecoms. Right, then looking to the how the market was driven in our last report to June to now, you can see tech 6 months ago to the end of June was a massive 1 year performer versus 10% on the 1 year to December. Banks definitely making their contribution, and as we said, local industrials and generally SA Inc. stocks doing better, with the likes of basic materials and some of the internationals weighing. Looking at the slightly longer term performance on the local indices, the 1, 3, and 5 year, as we can see, consumer goods, that's obviously Richemont doing its part, and basic materials, really the commodity stocks, helping the all share in the top 40 do fairly well. You can see a relative underperformance from the capped shareholder weighted index that was only up 45% versus say the top 40 of 51. Once again, you see industrials, that's the local industrials, and listed property, telecoms, all very dull or negative performances. Even the banks on a 5 year view, total price return of 20%. So looking maybe at the 3 year view, banks have recovered very nicely from their sell-off during the COVID sell-off, and the small caps also have recovered quite nicely. This doesn't really tell the full story. The small cap index is not a great proxy for what's happening in the small caps, but needless to say, it is indicative of an improvement even on the 5 year view, where small caps have generally been underperformers. The top 40 index, we believe, has actually been boosted quite significantly over the last few years, even if you go back to the SABD listing at a record level. But we had in 2021, in August I think it was, we had the Naspers Prosus reorganization, where Naspers went from being a very, very significant, I think it was 25% plus index constituent, way down. That was done at a fairly high level for Naspers. That, we believe, cemented in a fairly high level on the top 40. Similarly, when BHP did their reorganization with the termination of the PLC listing, also at a fairly high level, although it's subsequently recovered beyond that. And then more recently in 2023, the Richemont inward listing conversion, that also happened at a fairly significant level, and there Richemont went from a very significant index weighting to a far more modest weighting. So we believe all three of those actually create the illusion, if one wants to call it that, of the top 40 actually doing better than it truly did if you look at the underlying constituents. So the question then is, if you look over the last year or two, what has been weighing on performance apart from load shedding and other issues, anemic growth? And we believe that part of the explanation actually lies in the significant increases in the Regulation 28 foreign investment allowances for institutions that was introduced in early 2022. We believe that created an imbalance in the supply and demand in the South African equity market. South African institutions were probably generally overweight offshore, and this gave them more headroom. And effectively, what we believe it did was it's a significantly depressed appetite for SA Inc. stocks, with institutions preferring, particularly given the weakness in the rand and the South African economy, a strong incentive to divest from South Africa. So we believe, and this is obviously the capped SWIX, the capped shareholder weighted index. You can see from February 2022 that market's actually down, and we believe at least a significant portion of that was as a result of those foreign investment allowance increases. All right, very quickly, just PE multiple versus the EPS growth. We'll talk a lot more about this in the SA portfolio review, but as you can see there, if you take the Kerner Perspective core average, earnings growth probably around 13 to 14%, with PEs below 10. The usual cohort driving that performance, the likes of CUP, for example, have seen their earnings growth rates reduced over the last while, and maybe something like BHP increased, but generally the bulk of these counters are sitting on quite similar PEs and earning growth rates to what they were in June. So key conclusion from this is lots of value in the SA market, and we believe it's sort of, once again, a function of those foreign investment allowances. All right, the property market, we, as you probably know, are not big listed property fans. If you look at the global real estate index over 10 years, it's down, not massively. It's recovered quite nicely in the latter part of last year, but still down over 10 years and significantly down from where it was, let's say, in the beginning of 2022. And the forces obviously weighing on that, interest rates have done more than their share, but also just I think the shifts in the way economies fit together, move towards online retail, work from home kind of factors. So we believe in large part that global REITs, particularly more retail and office, will underperform, but we do see an opportunity in the logistics space, with one or two that we're having a fairly good look at the moment. But we still feel that maybe rates are going to hurt for a little longer than people think. Then the JSE listed property index, we've been fairly critical of listed property. The industry, or the sector, had a good rally towards the last 2 or 3 months of last year, and was actually, in terms of local performance, the standout performer, as you saw on a 1-year view. But it remains well below where it was 10 years ago, and probably even if you look to back 5 years, significant underperformance. So we would consider that a bullet dodged. So in summary, on our assessment of the asset markets, we believe that bonds, both local and internationally, look quite attractive, not only as an opportunity to lock in yield, but also maybe a little bit of capital growth. And really, I think we would look there to tilt away from cash and short duration towards government bonds. Cash yields are likely to fall quite a bit, so it makes sense to try and lock in yield through deposits, or, as we are looking at now, trying to find funds that offer slightly longer duration. So if it's a money market fund, ideally one with slightly longer term money market deposits. Equities are actually quite a tough call. Our preference remains on visibility and value. So clearly, the Magnificent Seven, with the exception maybe of Microsoft, do scare us a little bit, and we would rather invest in higher visibility, and we believe that the S&P particularly is maybe a little bit vulnerable to a sell-off, in part driven by the Magnificent Seven, but also if 2024 proves to be a slightly tougher year from a growth and by implication earnings per share growth point of view for the S&P. And then finally, the property outlook remains murky. We have looked locally at the likes of Equitas as a way to play the logistics and supply chain space. We think it's a good business, but sadly haven't really reached the point where we can pull the trigger. And we are looking at one or two internationally in that similar sort of space, but generally feel property should be avoided. We trust this was of value, and we hope that you will watch this, the coming videos being the local and international portfolio review, and those with an interest, the KP Flexible Fund report as well. Thank you for your time.